Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. As markets continue to grapple with the vast uncertainty resulting from the coronavirus, it was excellent to have Peter van Dooijeweert, the head of institutional hedging and portfolio solutions at Man Group, as a guest on the Alpha Exchange. Our Crisis series is aimed at uncovering the unique elements of the 2020 vol event, the extent to which systematic strategies acted as amplifiers on the way down, and the lessons learned from being long or short optionality. Addressing these questions, Peter has many insights to offer. As a market participant with 25 years of investing experience, he views volatility cycles as self-reinforcing on the way up and down. I enjoyed hearing his views on the clues resulting from correlation breakdowns, the usefulness of a blended cross-asset approach to hedging, and a risk management framework that uses volatility scaling. I hope you do as well. Thanks for listening, and please be well. My guest today on the Alpha Exchange is Peter van Dooijeweert. He is the head of portfolio solutions at Man Group, a $110 billion assets under management hedge fund. Peter, it's great to have you on this special Crisis series edition of our podcast.
Yeah, thanks for having me, Dean. It's a pleasure to be here.
Well, you and I have known each other for quite some time and have experienced some different vol cycles and risk cycles. I know you started in the mid-90s in the business in Tokyo, and so you've seen your fair share of cycles, of low vol cycles, of episodes of crisis. I'm just curious if, as we get started, if you can just tell us what's most top of mind for you as we are kind of a month after the high point, at least in some of the risk metrics like the VIX. Maybe we're 2 months into what really has become a massive economic sudden stop. What are the things asset price wise that you're thinking about most and have fascinated you most about this current period?
I would guess it's more a question of what our clients are focusing on going forward. If you've been in a tail hedge fund, you've done reasonably well. You've monetized in all likelihood a big chunk of that. And you're left with a decision of how might I continue investing. It's easy when you've made some money in tail hedging to kind of stick with it. And if you haven't, then you start looking at break evens in some of the puts out 1 year and think this looks pretty bad. At 15% out of the money put at 7 or 8% cost, break evens of down 23%. To most people, they think I'd rather be buying there until we get there. And then they're going to think, wow, I should have had that hedge. When I look at what the S&P is doing now, as bad as the year has been, there's still plenty of downside and there's still plenty of justification, I think, to talk about using options to hedge. But by and large, I think what we're more focused on, and certainly clients are more focused on, is having some kind of plan going forward that involves a lot of different ways to approach the same problem, which is to say risk mitigation. So you might use tail hedging. You might use some kind of active risk management. We've developed things in terms of taking some products internally on the risk management side and try to repackage them to futures overlays so that you're actively approaching your 60-40 portfolio allocation as opposed to passively saying, I'll just stay here static and rebalance. I think probably the number one question on our clients' minds is going to be a function of what's going on in bonds. Are bonds going to continue to be defensive going forward, given the 10-year has a 50, 60 basis point yield, which implies between now and the end of 10 years, you have maybe 6% worth of return, whether it's in the form of yield or yields go to zero, a one-day shock, for example, 6% of protection in your portfolio. That doesn't feel like really all that much, and it leaves pretty much anyone in a 60-40 portfolio relatively uncomfortable. And I say that with the backdrop of what happened in March, where the highly correlated sell-off across asset classes was hugely problematic. And when you take the 60-40 portfolio and you keep the 40 relatively stable, you can survive a little bit of panic in equities. But I think what we saw in March, where bonds started to sell off aggressively, taking down gold and taking down almost every defensive asset, including big move in dollar yen, the things you had relied upon working suddenly stopped working. So it wasn't surprising that the Fed stepped in. It wasn't surprising that everything stabilized. I was probably more surprised how quickly that the fixed income vol markets kind of reset themselves. The MOVE index, which is the fixed income volatility index, went from 160 to 70 in a matter of a couple of days. And that 70 is pretty much the midpoint of the range for the MOVE index for the last 10 years. So the Fed did all of us a big favor by quickly stabilizing the 40 side of everyone's 60-40 portfolios. It allowed you to get out of this panic liquidity universe where everyone was selling every asset to raise cash. Despite some people saying cash is trash, it turned out cash was incredibly valuable. And so once you've stabilized that side, then you've changed the argument in the market to one of potentially solvency and high yield, or earnings, inequities, economic growth forecasts, however you want to deal with the macro picture looking forward. That change is really important. But at the same time, it's not risk-free. So what the Fed can't really do is solve the solvency issue, and it can't solve where equities might go going forward. And I think that's the core problem that we're all faced with. And what people look for, tail hedge funds, vol funds, portfolio solutions people looking for ideas going forward.
You point to this very unnerving period. It was maybe 8 or so days when bonds stopped working defensively and actually became a risk asset subject to liquidation, just as the S&P and gold was as well. I think there was about a 10-day period where I think the S&P and TLT were down 13 to 15% each. And so in a liquidation, there's really nothing that can survive except maybe vol itself. You started your commentary around just thinking about the price of vol, the price of hedges. How should someone think about the increased cost of hedging via much higher implied vol set against what, of course, is a highly increased environment for uncertainty as well? Is there a potential for sticker shock? How do you find value in vol when the VIX is north of 40?
I think that goes to my point with the move next. I was shocked how quickly it got back into a range. And the VIX hasn't really. We're still generally well above the range of the VIX over the last 10 years. And it makes sense. The markets are moving a lot. And so internally, we believe pretty heavily that vol begets vol. So when we look at means of managing risk, vol scaling is something that we do and we use a lot across the business, especially on the quant side. And the idea of vol scaling, for those who aren't familiar, is basically when everything is moving on a 10 vol, you have a certain position. And if volatility on a realized basis or an implied basis jumps to 20, you basically have to cut your position in half to have that same P&L or feel like you have the same size position. So we've got quite a bit of academic research from us and from others that show you can't really tell so much if 1 month is up in the markets, what happens the next month. But if 1 month is volatile, you tend to know what's going to happen in the next month, that it's going to be volatile. Or if 1 month has a huge uptick in correlation, we tend to see a huge uptick in correlation in following months. So on that premise, you can start managing your portfolio. And so if you had a relatively fast volatility scaling approach in February, and certainly a lot of risk parity funds did, then you actually exited risk well before the rest of the market so that you left March with pretty modest drawdowns in long-only portfolios that were vol scaled. There's a bit of, I think, drama around whether volatility scaling exacerbated the sell-off because between CTAs and volatility scaling, vol targeting funds, that they may have had a lot of supply in equities. I think there's probably some truth to that, and we can explore that if you like. But what I think matters most to the investor is they got out of the way before some really significant drawdowns across these kind of vol scaled or risk managed portfolios. So when I look at options today, in Jan, it was pretty easy now in retrospect to say vol was cheap and mispriced the event. And so I'm happy to go buy the options because in a way, I'm outsourcing my risk management to the options market. If vol is cheap to these kind of crisis scenarios, and certainly we've seen tail funds make back everything they lost over the last 8 or 9 years and more, then it's okay to outsource your risk management to the options market. Here, when you're spending 30, 40 vol, depending on the maturity, between 8 and 10%, depending on the strike for options or downside puts, that cost of outsourcing your risk management starts to feel a little bit more expensive. And it's certainly pretty tough to do this against your whole portfolio. Imagine spending 9% on a 1-year put. Basically, you need the S&P to rally almost to 3,000 just to cover the cost of that put. So I think it's pretty hard for investors to mentally get their head around the idea that up 9% is my break even if the highs in S&P are 3,300. You just have to believe that all this, the fiscal measures and all the Fed actions will heavily stimulate the market. You're probably betting some on inflation, in fact, in terms of asset prices. So you need all of that to work really well to feel good about your puts. The flip side is, since the virus outcomes, we're going to reopen at some point. People are focused on all the new cases, but we see the flattening of the curve as everyone wanted. There's going to be reopening. We don't know how it's going to turn out. There's all kinds of data we don't know. And one of the things I joke with investors is, If our quant arm got the data that we get from the CDC or the Worldometer's website where you can see how many cases there are per day, it would be the worst and most unreliable data set ever used. So it's pretty much useless to make decisions off that. And we're just going to kind of go as we go. And so from that perspective, we prefer looking at something like a volatility scaling approach where if vol doesn't come in equities and it keeps jumping 3%, falling 4% as it is, then maybe the market's just not investable. And I think in a way, we're seeing that in crude. What happens when a market becomes utterly uninvestable at 100 or 300% moves? I mean, the idea of a crude one strike put trading at $2 or $3 and having no way to be risk modeled. It's a challenge to risk management systems for sure, but it probably underlines the possibility that markets just aren't stable enough to get massively long here. As much as everyone wants to own the dip and enjoy whatever rally comes as we come out of it, we look at it more over the broad arc of time that if you have some kind of systematic approach to doing this, you'll miss the next 200 points, but at least you can get in a level where it's stable and you can feel confident about the fact that you rebalanced your portfolio or increased whatever your exposures are.
People talk about economic cycles, and then there's also these long financial cycles. Sometimes they're just so much longer than maybe we think that they can endure. I remember you and I talking quite a bit in the pre-crisis era, 2005, 2006. VIX was 10, credit spreads IG got as low as 20-ish. And it just seemed like a never-ending, almost self-reinforcing risk-on cycle. And the hedger ultimately kind of dies the death of 1,000 cuts. And in some cases, there are stories where folks abandon hedging programs that they had committed to for a bit right before, unfortunately, this vol event occurred. How does someone manage through those real lean periods where realized vol is quite low, it underperforms implied consistently? What are your thoughts on just managing through the quiet periods?
I think that's quite a challenge. It feels a little bit weird to talk about it right now, given where vol is. But in a way, what you can kind of generically say is, I know that owning vol or puts right before a crisis is a reasonably smart thing to do. And I know that owning this stuff at the end of a crisis is a reasonably dumb thing to do. But I don't really know when the end of the crisis is going to be. And I certainly don't know the onset of the next crisis. So the challenge of what we're faced with as, say, vol managers or tail hedgers or any kind of risk manager is what to do between the end of one crisis, which, again, we don't know what it is, and the beginning of the next one, which could be incredibly painful in terms of underperformance, poor return. You could have an EM debt manager who's incredibly bullish and has made a ton of money and loses all in a day, an incredibly bearish EM debt manager who hasn't made money for years and years and lost investors and then finally has a big payday. So we're all faced with those challenges about how do you survive your hedging program in a way? And I think that's what we're supposed to do. And so coming into this crisis, the way you survived it was to try to make it cheaper. You're looking for some form of basis risk. For example, high yield. If you talk to a credit guy, they thought vol was expensive, but relative to equities in February, high yield was pretty cheap in terms of buying puts. And so was emerging market debt and some other things that you could look at from a basis perspective that have reliable beta and panics. And therefore, you had a chance to get a lot of notional on, a lot of protection for not a lot of cost in this pure crisis scenario. And I think the tail funds who did really, really well did those kind of things, whether it's owning way out of the money VIX calls for a tiny premium, but more likely using some of these other asset classes. The rub to that was if you concentrated your hedges in one place, that's where you really run into trouble. If you're always using S&P, it's the most expensive over time. And so you run some risk that you're just going to get stopped out of this hedging program. But if you move things around and say, you know what, I'm going to own these 4 or 5 different asset classes, you can afford the fact that JPY, yen didn't work for a couple of days and then it fell apart on you. You can afford if the euro doesn't move as much as it did during 2008. What I think you want to avoid, in a sense, is the overly backtest fitted strategies where you have various banks selling pretty aggressively fitted strategies that worked amazingly well during 2008, but have a short vol component in them. There's some kind of sell something to buy something. Well, that gap risk turned out to be incredibly painful. From here, in the short term, I'm actually quite hesitant to use too much basis risk in the sense we've seen plenty of large gross hedge funds struggle phenomenally with that. So if anything, you don't want to increase your gross. So if you decide today, hey, the yen is still a pretty good hedge, it has all the risk off criteria I want, it doesn't really let you reliably be long equities. Whereas if you, let's say, credit were trading cheap in vol, You might make that bet and say high yield, for example, which doesn't have the support of Fed as IG does, has some support, but not nearly the same. High yield has solvency issues. So you could look at that as some sort of an equity proxy. But given the pretty big underperformance of the HYG and where it sits relative to its own history and the strong outperformance of S&P, direct hedging right now looks better. It's not the most satisfying answer, I don't think, for most people because it's pretty expensive and the break-evens don't look great. But we have a market from 2008 that has moved as much as it has. When you compare that to credit, you compare that to inflation break-evens, all the other things we're looking at, they experience much sharper downside and still haven't quite recovered all of that kind of move lower. So it's not clear to me that you want to use basis risk for the short term. So you kind of have to balance that. And that goes to a frequent point we talk about with clients, which is don't put all of your hedges in one basket. Don't say, I'm just going to use equity collars, or I'm just going to use equity puts because they're the most efficacious, even if it has some cost. I'm just going to use some kind of exotic options, a whole bucket of exotic options, because I'm pretty sure they'll pay off. It's much better to kind of live among these asset classes. But in a way, what jumps out also for me in terms of basis risk is what the Fed has done for the market over the last 10 years before the crisis. And effectively, by always being there, I think we were all a bit surprised the size of the market's reaction in Q4 18 to a little bit of Fed hiking. The Fed bailed out quickly. The Fed put was a lot closer than we thought at the time. And so they created this voracious demand for assets, especially in credit, where you saw a lot of stuff trading a lot tighter than probably realistically it should be in terms of credit spreads. And now you have the knock-on effect of that. There's a lot of investment grade paper that probably should have never been investment grade, was generously rated, overbought by investors. And the net effect is by creating this huge tidal wave of demand coming into this, the Fed had no choice but effectively to buy the fallen angels that they themselves more or less created through this hyper-stimulative environment. And that's where I worry going forward, because yes, they've created this high yield bucket. They're buying the high yield fallen angels. And in theory, that will help stabilize things over time. But the solvency issues facing all these companies are exactly the same. The protective levers they have are going to be quite different, though. So your portfolio that relies on bonds doesn't have that much to make. If you go into IG, you can feel like the Fed will buy some there and protect you some. So maybe you pick up a little extra yield, but you're still stuck with all that rate risk and still stuck with solvency issues. So you have a big chunk of your portfolio right now that you don't know what to do with. And I think that's quite a challenge for investors.
So one of the things that you were alluding to, I think, before was just around some of the systematic strategies that operate within and sometimes in a significant way within the market. Vol control being one that gets a lot of attention. The realized vol over 10 days in the S&P peaked out at 125% during that most protracted period, call it the second or third week of March. That outstripped even that during the global financial crisis. It's pretty close to 1987, where you had one day of a 20% move. So this was just as violent as it gets. And I'm wondering just the degree to which you think about the strategies in the marketplace that existed coming into it and as a potential accelerant. Of course, the market's confronted with just an incredible amount of new news that it needs to react to. But what about the strategies themselves? How much attribution do you give to the just phenomenal burst of volatility that we saw? How much of it's a function of that deleveraging process?
I think you would be wrong to say it didn't matter. And I think you'd also be wrong to say it caused it all. So vol targeting is obviously reaction to vol increase. So the first thing that has to happen is something has to happen, whether it's a gap down or an increase in vol for some reason. When I look at the range of strategies, people will talk about risk parity and CTAs kind of in broad brushstrokes. You're left with a lot of different speeds. So certainly trend funds were quite long market early in February. It was a strong uptrend. Some, I think, and internally we have a number of vol signals when momentum becomes extremely sharp to the upside. We actually turn longer a vol as a firm, and we have some hedging instruments. We reduce exposures because it typically is some kind of finishing part of the move. And so that makes a difference to how long a trend fund might be. And it certainly makes it difficult, I think, there's a bit of a closet group of derivative strategists who like to guess how long trend is, how long risk parity is, and send out lots of emails and tell you when to buy the dip. And I think they told you to buy around 3,200 and then 3,100. And now they're telling you to sell. So it's not the most reliable way to run your book. And I think most pension and slower money clients aren't day trading this stuff. So there's obviously guesswork going on the side of the people who aren't doing it. But what's mattered the most on both trend and the same with vol targeting is the speed you're using. So if you're a super fast trend manager, you got out of risk super early, but at the expense of returns over the last X years. Every time you sold a dip, the market bought the dip over the last 10 years, and that's been problematic. If you're super slow, you may not have gotten out of this before the lows. You may have been kind of steadily reducing risk as we approach the lows. And that's true for both vol scaling and for trends. So most trend managers, I think, got out of the way fairly early in February and actually managed to make some gains either in their bond holdings or some of their other asset classes that they're already short. That worked reasonably well. So by and large, you feel like trend did an okay, if not amazing job. If you were faster, though, you have pretty decent returns. And if you've been in that kind of medium speed bucket, you probably had the right balance between not wasting too much money in the slow last 5 years leading into this and not being caught long. The vol scaling side looks very similar. If you're using very long dated vol to scale your portfolios, because that's what backtests and looks greatest over the last 50x years, then probably you were more exposed than you might have liked to be, and you might have ended up at a similar return to a typical 60-40. If you were fast, you might have gotten out quite early and could leave yourself looking very good because you reduced risk dramatically. And so S&P now realizing 125, it's that the biggest constraint is it's going to take a while for the vol scaling universe to put back on risk. And so as we rallied, there are a lot of pieces put out what eventually the vol target guys are going to buy back their equities. That's true, but in this size of a dislocation, it's pretty difficult to see exactly when, because just when you think we're kind of stable at 40, 50 realized vol, you have another 3% down day. 40 or 50 vol compared to realizing 7 to 8 vol for quite some time, you're not exactly going to full risk anytime soon. So they may position late, so maybe there's a bit of a squeeze coming relative to that. But by and large, I think it was probably a bit overstated how much of an impact these funds and strategies had. You know, obviously, we're a quant manager, so you can take it with some of a grain of salt, but I sit inside Man Solutions, so I'm kind of independent of the quant arm, independent of the discretionary arm, so I kind of observe what I observe. And I would say, yeah, the market probably overstated it. The size of what was actually traded relative to the size of what was traded in the market, obviously the notional and equity futures and bond futures dwarfed anything that these funds had to trade. That said, in late Feb, there's no question everyone knew how much was coming for sale. And so there was clearly a little bit of front running by macro funds and others ahead of what looked like a reasonable amount coming for sale. By the time you got to the March lows and everything, it's probably a bit much to blame the risk parity guys for selling bonds and selling equities because a lot of them have de-risked. And at the time, it wasn't so much just risk parity. Everybody's 60-40 portfolio looked bad. Every asset manager on earth with bonds was suddenly incredibly nervous. So you weren't really looking at maybe a $1 trillion tops universe of vol targeting. You're looking at a $100 trillion market of bonds versus equities. And that, I think, is much more important. And that's why the Fed stepping in had to be in huge size. If they'd stepped in for $1 trillion, they would have bought anything times 6 or 7 that any risk parity guys had left to sell. So it wasn't just risk parity. And it's probably overstated how important those kind of technical flows certainly are from here, and maybe they were at the lows. But not overstated, which sounds like I'm equivocating a bit, but not overstated for February, where, like I said earlier, if you had those tools in your portfolio, you actually got out of the way of a lot of risk. And isn't that what you're supposed to use those tools for? It's just like saying a tail hedge guy bought options and made a lot of money. Well, we shouldn't allow tail hedge funds to trade because they exacerbated the market by creating negative gamma around the strikes that they bought. It's the same with vol scaling. Why should we turn off a tool that works so effectively for investors, especially if you use medium speed for vol scaling or fast speed? Why turn off that tool when it's so effective and even more effective than tail hedging in most cases? Because by and large, the tail hedge index maybe made 2.5 times what it lost in any one given year. They should have been making 5 to 10 times their budget in terms of losses or spending. So the vol scaling side certainly looks a lot better than that.
And can you just explain a little bit more on the implementation of vol scaling?
So imagine you start with a 60-40 portfolio, and let's use the reference vol level around 18 for 1 year vol. It might have been somewhere around that point. The idea of vol scaling, again, is that volatility begets volatility. So if we believe, and there's a lot of academic research to support it, that an increase in vol in 1 month will lead to serial increases in vol in subsequent months, then Usually, market prices are associated in a downward way. They're negatively correlated to that jump. So we would expect asset prices to decline on increasing vol. So if we feel confident about that academic literature, and certainly this experience, I think, more than validates it, then we should be thinking as vol increases, we should decrease our exposure. So taking this simple 60-40 portfolio, which I guess the 60-40 is realized between 8 and 10 over the last X years as a combined, we can look at that as a reference point instead of the 18 for S&P. Let's just say 8 to 10 is about what a 60-40 portfolio is. If we see that jump to 12, let's just use realized vol rather than anything else. If it jumps to 12 on some basis, 30-day, 1 year might be long, 10-day is probably far too short, but let's just use 1 month and jumps to 12. Well, we need to do something to get our portfolio to come back to 10. So we simply go sell 20% of the portfolio. And at this point, ignoring risk parity, let's just assume we were doing 60-40 only, then we've taken our risk down to something like 48-32, and we're sitting in cash for the balance. Most risk parity funds actually will potentially put on a lot more bonds and potentially own even more equities and feel like they're reasonably well constrained in a low vol environment to take some extra risk. And once we start increasing in vol, they'll react dramatically quickly to reducing risk and potentially going all the way to zero. So some risk parity funds today might look like they have 3 or 4% equities and almost no bond exposure. And that's a reflection of that volatility scaling, because at 50 vol, you can really only own 1/5 or so of what you had in the first place. And that's really what you're going after, is the idea that when it's volatile, you don't want to be long. And as volatility declines, you enter a universe where, I can be a little bit longer as long as I have some kind of aggressive risk management. And so when I look at how we develop some of our futures overlays for clients, it's not just vol scaling. We add other risk management tools to it, whether it's potentially going risk parity in terms of equities and bonds, adding some kind of correlation model so that when we see asset correlations picking up, not on a daily or weekly basis, but on an intraday basis, we start cutting risk aggressively. Or we look at some kind of trend model where, to the extent that vol is picking up, but not dramatically, and the markets are going down steadily, kind of like Q418, you're still reducing risk. So instead of attacking this with one tool or one risk management approach, use a few different overlays so that you're cutting risk aggressively. And what was interesting about some of this is that bond equity correlations picked up dramatically at the lows. And we're giving a pretty big warning that you shouldn't be long anything. Now, it turns out the Fed stepped in and solved that. But that's a pretty good thing to know about risk, that the last time this happened, the bottom fell out of the market in a big way. And so you should be reacting accordingly to that.
One of the things I think that the Fed was responding to, specifically in the bond market, was the breakdown of some of these basis relationships and its understanding of how much leverage was deployed in pursuit of essentially extracting these quite tight arbitrage relationships. Could have been cash versus futures, but lots of leverage deployed. And you mentioned earlier some of the incredible volatility in crude. Some folks talk about volatility as, in some ways, inversely related to liquidity. And just wondering, as some of these correlation relationships break down and as we see just massive dislocations in almost asset class by asset class, it seems like a round robin. How does just the liquidity environment figure into how you guys think about managing risk and some of the strategies that are on the defensive side in terms of hedging? What do you see coming in an environment where folks have lost money, vol is much higher? How does future adjustments to liquidity figure in?
I think you have to assume that liquidity is going to be problematic. And in a way, a vol scaling program assumes that by cutting risk when vol's high. But actually, any strategy where you're going to have some kind of active risk management, whether you implement it yourself or you hire another firm to do it, you're going to be pretty dedicated and reliant upon either yours or their technology to trade. And so in a way, it's handy for us. We have a big platform. We trade a lot of futures. We spend a lot of money on the technology. But if the market doesn't have any liquidity, it just doesn't have any liquidity. And so I think you definitely have to factor that kind of a piece in going forward, where you say, I'm going to build a portfolio that's this new regime portfolio that bonds don't have much money left. So I'm going to own equities. I'm going to own gold. I'm going to own tips because the break-evens have collapsed. And so it's a pretty smart way to own bonds in a sense. You might make the call that inflation is coming. Break-evens are very low. So if this all pans out and stimulus worked, I can see an argument, and maybe I can explore that in a bit, but I can see an argument to own tips. So you're building this new regime portfolio, and all of a sudden crude falls 100%, and everything changes in terms of what your expectations are because the bottom fell out of the short-term contract. We shouldn't expect that to matter to anyone, trading gold futures in the short term because that thing's not going to zero per se. But it's certainly going to matter in terms of how your newfangled, robust portfolio is going to do. Because if gold's going to move 4 or 5% when you don't expect it, or if margins are going to increase dramatically on futures when you don't expect it, you can have some pretty ugly outcomes. And imagine if someone wants to take physical delivery. I think Gundlach's made some comments to that effect, and rightly so. What happens when gold futures, which aren't gold, trade off because they're not really the physical commodity? How are we all set up for these sorts of things? So as much as liquidity matters and whatever program you're building matters around liquidity, I'd be much more concerned about how durable and time-tested are these things really? Because doing 100-year back test doesn't tell me a lot. Doing crisis back test doesn't tell me a lot because if you pick the right window for gold in 2008, you lost a lot of money. If you went all the way to the end of 2009, you've done very well. So diversification really does matter, and we're a reasonable believer in that diversification helps and allows you to take some leverage and increase some exposures to your portfolio. But we need to be aware of the fact that a lot of this can go wrong really quickly. And so as much as I like some of the real defensive strategies, low vol and quality, they are reliant somewhat on high gross exposures. And so those gross exposures get pretty tricky when liquidity is low and things start marking against you fairly quickly. And you say, look, let's just right size this a little bit. If we don't make a good call on liquidity, right sizing the portfolio just to do what we want can be more expensive than any gain we might hope to make from it. And I think we'd be foolish not to have some kind of liquidity benchmarks in there to control that. And we certainly established that for most of our investments in the firm.
So Peter, as we finish up, I'm just curious to solicit your views over the course of your career on this thing that they call the vol risk premium. It's been a tried and true way of generating return, reasonably stable, of course, subject to drawdowns. And this last period has been just a massive drawdown, just given the shock higher in realized vol. What do you think emerges from people's thinking around this strategy, just given how much damage this crisis has done to the strategy?
Yeah, so I'd like to think that people will be pretty shy about selling vol again, but I can tell you we've had plenty of internal and external conversations that center around when's it going to be safe to sell vol again. And I guess I would take a step back to really talk about what this vol premium has been and has it really made money. And since 2017, you've pretty much only lost money doing it. And so if we take the returns back to 2016, you might find some smattering of positive returns. But then 2018 was a mess, as we all know. 2019 was choppy. And whatever you hope to make here is kind of obliterated it. And I think in part there's some money being made in selling vol in some unique ways. Most of it, when we've seen vol funds make money, has been selling crash risk and selling skew and variance swaps. And those funds are clearly out of business 1 month on into this. So they've disappeared. So if you sold crash, it looks like vol premia, but you sold levered crash/vol premia. On the other hand, if you're just a vol seller, you haven't really experienced much in the way of return relative to your risk. I think where people have made money is more in selling puts and using that as a means to make money. And that makes some sense in the sense that we have a risk premium in equity that generally is positive and generally markets tend to go up in equities. I'm not sure we're going to feel as confident about that going forward because we have bonds at very low yields. So it's not 100% clear that you're going to feel stable enough to sell a bunch of puts inside your 60-40 portfolio to earn yield because you know that part of your portfolio isn't going to provide much protection. But by and large, I think as you look at selling vol as an asset class going forward, it might be the right moment. If you pick the bottom, it's always the right moment. But there are plenty of other asset classes that are heavily dislocated and look like they have better return characteristics than equities. And that's been a conversation I think with a lot of clients are find me things that are dislocated that might have a better return on a risk-adjusted basis than equities. And that might have been high yield before the Fed and even now. It might have been something like European dividends, which every bank in the world wants you to buy. It might be Treasury inflation adjusted securities so that you have some kind of inflation break even at a very low point. You think that's a dislocation predicated on liquidity, so I should buy something here, or I believe that stimulus is going to drive inflation higher. Whatever it is, I can list off 10, 15 asset classes of strategies like risk arb that look like they're pretty dislocated and probably look like a better trade than just selling vol. And without all the hassle of trading gamma and wondering what kind of crash risk you've created and some negative externalities where you get fired for basically going short vol, But you get asked, should we get bigger when something like risk arb gets a little bit wider and represents a bigger opportunity?
Lots of good insights there. And Peter, I want to thank you again for being a guest today and sharing your views during obviously a challenging time and a fascinating time as well for markets. Hope you and your family are well.
Yep, thank you. It's been a pleasure.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.